I have to start today with a question that,
Sure.
honestly, it sounds like it was ripped straight out of a pirate movie or maybe a high-stakes heist film.
Okay, I'm intrigued.
Can you actually retire on a pile of gold?
A literal pile.
Right. And I don't mean buying a few nice necklaces for your spouse or keeping a fancy watch in a safe. I mean, can you legally look at your retirement account, your life savings, and instead of seeing stocks or mutual funds or bonds, you see literal gold bars?
It is a really compelling image, isn't it?
Yeah, it's very Scrooge McDuck.
Exactly, swimming in coins. But the short answer is yes, you can.
You actually can.
You can. However, it's not quite as simple as burying a chest in your backyard and marking it with an X on a map. We are talking about a very specific, heavily regulated financial vehicle known as a Gold IRA.
Right, the Gold IRA. We've all seen the ads on late-night TV, usually featuring some D-list celebrity standing in front of a flag.
Telling us the dollar is doomed.
Exactly, telling us the sky is falling. But today, we are skipping the fear-mongering, and we're skipping the sales pitch. We are taking a serious, deep dive into the actual mechanics.
Yes, getting into the details.
Based on a report titled Types of Gold IRAs Explained.
And we should note, this isn't just a blog post from a random gold enthusiast or a local coin shop owner trying to move inventory.
Right.
This analysis comes from the Gold IRA Company's Bulletin, and specifically, it is authored by Doug Young.
We should pause just to establish who that is, actually, because in the finance world, the source really is everything. I mean, anyone can write a blog post. Who is Doug Young?
He is absolutely a heavyweight in this specific niche. He's a financial markets researcher with over 20 years of experience.
Okay, so he's been around.
Very much so. But more importantly, he served as a financial director at World Freight Services Ltd. for 16 years.
That's a serious corporate background.
It is. And he has been specializing in gold IRAs specifically for over 15 years.
See, that distinction matters to me. He isn't just a writer, he's been on the operational side of finance.
Precisely. The precious metals market can be a bit of a Wild West, honestly.
Yeah, I can imagine.
You have aggressive salespeople, complex fee structures, and regulatory tripwires that can really hurt you if you aren't careful. Young has actually conducted over 80 evaluations of gold IRA companies since 2011.
Wow, 80.
Yeah, so when he breaks down the different types of accounts, he is speaking from a place of deep structural knowledge. He knows where the bodies are buried, so to speak.
Okay, so here is our mission for this deep dive. We're going to decode the alphabet soup. We keep hearing about traditional Roth SAPE.
The acronyms.
Honestly, my eyes usually glaze over when I hear those acronyms.
Yeah.
But we're going to figure out exactly what they mean for gold investors specifically.
And we're going to look at the hard numbers, specifically the 2026 contribution limits, which are vital if you're planning your tax strategy for the coming year.
Right. So whether you are listening to this because you're prepping for a meeting with a financial advisor, or you're just insanely curious about why anyone would move their money out of the stock market, which has been doing pretty well historically, we have got you covered.
Let's get into it.
But before we get into the specific accounts, I want to push back a little on the why.
Okay, fair enough.
Because most of us are taught a very simple formula from the time we get our first job right. Buy index funds, hold them forever, let compound interest do the rest.
The standard advice.
Yeah. Why fix what isn't broken? Why does Doug Young argue that someone should complicate that by looking at gold?
Well, Young argues that the set-it-and-forget-it strategy in purely paper assets has a critical weakness.
Which is?
It comes down to the concept of a shield. If you look at the source material, he highlights three main arguments: volatility, inflation, and diversification.
Yeah.
But the one that really grabs you is the protection against market volatility.
Volatility, which is basically the polite financial term for the market crashing and ruining your plans, right?
Pretty much. Young points to a very specific painful memory for a lot of investors: the 2008 financial crisis.
I remember that clearly. It wasn't just numbers on a screen.
No, it was real panic.
People who were planning to retire in 2009 suddenly realized their 401ks were cut in half. They had to work another 5 years.
Exactly. That is the trauma of volatility. And here's the data point Young highlights. While the stock market was plummeting, losing massive percentages of value across the board, gold prices actually surged.
Oh, so it acts as a counter move.
Yes, we call it negative correlation. When fear creates panic, selling in paper assets, like stocks and bonds, capital has to go somewhere.
Right.
It tends to flee to safety. It flees to the tangible. Gold acts as that cushion. If your entire retirement is in stocks, you're fully exposed to that crash.
Take the full hit.
Exactly.
Yeah.
But if you have gold, you have a non-correlated asset, something that doesn't necessarily dance to the same tune as Wall Street.
So it's basically the don't put all your eggs in one basket advice, but with a historical track record. It's not about getting rich quick. It's about not getting wiped out.
That's the key distinction. You aren't buying gold to chase a 500% return like a hot tech IPO. You're buying it to make sure you have money left if that tech stock goes to zero. It is insurance.
That makes sense. Then there's the second point Young raises, which is inflation. And this one feels a lot more relevant to our daily lives right now.
It absolutely does. Young explains that over time, inflation erodes the buying power of money. We all feel this, right? $100 at the grocery store simply doesn't fill the cart the way it used to.
It barely fills a bag these days.
Right. Now, why does that happen? Paper money loses value because governments can print more of it. It's unlimited.
But gold isn't.
Exactly. Gold is finite. It is a tangible store of value. Historically, as the cost of living increases, the value of gold rises to match it.
Can you give me an example of that? Because sometimes store value sounds a bit abstract.
Sure, think of it this way. In the 1920s, an ounce of gold was worth about $20. That $20 could buy you a really nice, high-quality tailored suit.
A $20 suit, those are the days.
Right. Now, today, an ounce of gold is over $2,000.
Okay.
That $20 paper bill from the 1920s, it might buy you a pair of socks today if you're lucky.
Yeah, true.
But the ounce of gold, it will still buy you that really nice, high-quality tailored suit.
Oh, wow. That is a fantastic way to visualize it. So the purchasing power remained identical for the gold, but the dollar completely collapsed.
Exactly. So by holding gold in an IRA,
Yeah.
you aren't just trying to make a profit in dollar terms, you're trying to preserve your purchasing power. You want your retirement savings to actually be able to buy things in 20 years, regardless of what the currency is doing.
Okay. Let's assume the listener sees the value in that. They want the shield. They want the suit.
Right.
Now they have to pick a container to put it in. The source breaks this down into three main types of gold IRAs. Let's start with the classic, the traditional gold IRA. What are we dealing with here?
The traditional gold IRA is the most common structure. The headline here is pre-tax.
Pre-tax, let's translate that. If I earn $100,000 a year and I put money into this, what actually happens?
It means the money you put into this account this year is deducted from your taxable income for this current year.
Oh, okay.
So if you put the maximum into your traditional gold IRA, the government taxes you as if you earned less money overall.
So I get a tax break right now. I keep more of my paycheck today. That sounds pretty great.
It is great for immediate cash flow.
Yeah.
But, and there's always but with the IRS, the money grows tax deferred.
Meaning?
That means you don't pay taxes on the gains while it sits there. But when you retire and start taking the money out, whether you are taking physical distributions of the gold or liquidating it, you pay income tax on it then.
Okay, so I am not escaping the tax man. I am just rescheduling the appointment.
Exactly. You're pushing the tax bill into the future. And this is why Young suggests this is ideal for a specific type of candidate. If you are a high-income earner right now, you are likely in a high tax bracket. You want to lower your tax bill today because it hurts.
And the assumption is that when I retire, I won't be working, so I will be in a lower bracket.
That is the standard financial planning logic. You avoid paying 35 or 37% tax now and pay maybe 20 or 22% later. It makes mathematical sense.
Okay, that logic holds up if tax rates stay relatively stable or go down.
Yeah.
But what if I don't want to worry about taxes in the future? What if I think the government is going to raise taxes significantly by the time I am 70? Or what if I just hate the idea of a looming debt to the IRS?
That is a very real concern for a lot of people. And
Right.
if that is your mindset, you are looking at option number 2, the Roth Gold IRA.
The Roth. This is basically the darling of the personal finance world right now. It seems like everyone under 40 is obsessed with the Roth.
For good reason, honestly. The mechanism is the exact opposite of the traditional. You fund a Roth Gold IRA with after-tax dollars.
So I pay up front.
Yes. You get your paycheck, government takes their cut, you pay your taxes, and then you invest the remaining money.
So no tax break today. I feel the pain immediately.
You do. But here is the payoff, and it is massive. The growth is tax-free. And crucially, the withdrawals in retirement are tax-free.
Completely tax-free.
Yes. If gold prices double or triple over the next 20 years, you don't pay a single cent of tax on that profit when you take it out, provided you meet the standard age and holding requirements.
That sounds incredibly powerful if you have a long time horizon. You bite the bullet now to eat for free later.
It is powerful. But there is another hidden gem in the Roth Gold IRA that Young highlights, and it's something people often overlook when they're comparing these.
What's that?
It is no required minimum distributions, or RMDs, during the account holder's lifetime.
Whoa, hang on. Required minimum distributions. That sounds like jargon designed to bore us to death, but tell me why it actually matters.
It matters because it controls your money. With a traditional IRA, when you hit a certain age, currently in your early 70s, the government forces you to start taking money out of the account so they can finally tax it.
Oh, because they deferred it.
Exactly. They want their cut. They won't wait forever.
But wait, what if the market is down?
That is exactly the danger. Imagine the market crashes. Your gold value dips temporarily. In a traditional IRA, the government says, I don't care, sell it and pay us. You are forced to sell at a loss.
Ouch. That sounds really painful. But with the Roth,
Because you already paid taxes up front, the government doesn't care when you take it out. You can leave the gold sitting there, growing tax-free for your entire life. You can pass it on to your heirs without ever having been forced to liquidate a single ounce.
that is a huge strategic advantage for estate planning. So the Roth is for people who want to minimize tax burdens later, or who expect to be in a higher tax bracket in the future, or frankly just want the government to stay out of their withdrawal schedule.
Exactly. It offers complete control.
Okay, so we have the traditional for the tax break now crowd and the Roth for the tax break later crowd. But then Doug Young introduces a third player, the SEP Gold IRA. And reading the source, this one felt like the heavy artillery.
It really is. SEPI stands for Simplified Employee Pension. Now, this isn't for everyone. The source is very clear. This is the power tool for self-employed individuals and small business owners.
So freelancers, consultants, contractors, small shop owners, this is for you.
Right. If you have a W-2 job, you can tune out for 30 seconds or just grab a coffee. But if you are your own boss, listen closely. The reason the SEPI is a heavy hitter comes down to one thing: contribution limits.
I saw those numbers in the text and my jaw actually dropped. But before we spoil the surprise, how does the SC work regarding taxes?
It functions essentially like the traditional IRA. Contributions are tax deductible, so you lower your business's taxable income right now, and the growth is tax deferred. You pay taxes when you withdraw in retirement.
Okay, so the tax structure is familiar, but why does Young say this allows business owners to aggressively boost retirement savings?
This brings us to the numbers game. We need to look at the 2026 limits to really see the difference.
Lay it on us. What are we looking at for next year?
Okay, for 2026, if you have a traditional or a Roth Gold IRA, the combined annual contribution limit is $7,500 if you are under 50.
7,500. Okay,
Maybe.
that's fine. It's a nice vacation or maybe a used car, but it's not exactly buying a private island.
Right, and if you are 50 or older, there is a catch-up provision that bumps it up to $8,600.
So roughly $8,000. That's a decent chunk of change, but it is limited. I mean, if I have a great year and make $200,000, I can still only shelter $8,600.
Correct. You're capped. Now let's look at the SEP Gold IRA limits for 2026.
I'm ready.
You can contribute up to 25% of your compensation or $72,000, whichever is less.
72,000.
$72,000, yes.
That is, I mean, that's nearly 10 times the limit of a standard IRA.
It is a massive difference, and this is why it's such a critical option for the self-employed. If you have a banner year in your business, let's say you land a huge contract, you usually get hit with a massive tax bill.
Oh, absolutely.
The SA allows you to take a huge slice of that profit, up to $72,000, and hide it from the tax man immediately by converting it into gold for your future.
It really changes the calculus. Instead of just saving a little on the side, you're basically building a fortress.
Fortress is a really good word for it. It allows you to catch up very quickly if you started late, or to build a really substantial safety net that is entirely decoupled from the stock market. For a business owner whose income can fluctuate wildly, having that ability to stash away a huge amount in a good year is a game changer.
So we have these three distinct paths: traditional Roth's essay. And the numbers make it pretty clear who fits where. But let's zoom out a bit. When we look at all this information from Doug Young, how should a listener actually make a decision? Because it seems like the decision isn't actually about gold at all.
You hit the nail on the head. The decision to buy gold is step one. That's the asset allocation decision. You decide you want that shield against volatility and inflation. But choosing the type of IRA isn't about the metal. It's entirely about your personal tax timeline.
Right. It's a tax strategy question wrapped in gold foil.
Exactly. You have to ask, Do I need the tax deduction today to make my business viable or to lower my current high bracket? That points to traditional or SEP.
Hmm.
Or am I willing to pay the tax now to have total freedom and tax-free income later? That points to Roth.
Now, there is another layer to this strategy that we really need to touch on, the execution. Because you can't just walk into a regular bank and say, I'd like to put some gold bars in my account,
No,
please.
you definitely cannot do that. Young notes that finding the right Gold IRA provider is absolutely necessary to navigate the complex market. The bulletin even lists reviews for companies like Augusta Precious Metals or Goldco.
And to be clear, we aren't endorsing anyone here, we're just citing the source.
Right.
But why can't I just do it myself? Why do I need a specific gold IRA company? Why can't I just buy some coins and put them in my safe deposit box?
Because of the IRS. The IRS has very strict rules about fineness. The gold has to be 99.5% pure to qualify for an IRA.
Okay.
You can't just throw in some old coins you found at an estate sale. Furthermore, and this is the big one, you cannot hold the gold yourself.
I can't keep it in my home safe, even if I have a really good safe.
Absolutely not.
Okay.
That is considered a prohibited transaction. If you take personal possession of the gold in your IRA, the IRS treats it as a full distribution. You will owe taxes and penalties immediately.
Oh, wow.
Yes, you need a custodian, a secure IRS-approved depository to hold the metal for you.
So don't try to get clever and bury it in the backyard. That completely defeats the whole tax purpose.
Exactly. You need a partner who ensures the paperwork is clean and the storage is legal. That's why Young spends so much time evaluating these companies. He's looking for transparency and compliance.
So bring it back to the big picture. We have got the volatility shield, the inflation hedge, and the massive contribution limits if you are self-employed. It feels like a very different way of thinking about retirement than the standard buy stocks advice.
It all ties back to that concept of this safe haven.
Mm-hmm.
The source material emphasizes that gold is there to stabilize the portfolio. It's not necessarily about trying to beat the stock market every single year. It's about ensuring that when the stock market has a bad year or a bad decade, you have a cornerstone that stands firm.
It's a ballast in the ship. It keeps you upright in a storm.
That's a perfect analogy. And for many people, knowing that a portion of their wealth is outside the digital banking system in a physical asset provides a peace of mind that a spreadsheet just can't offer.
So let's do a quick recap for everyone before we wrap up. We threw a lot of numbers around today.
Sure, let's simplify it.
Yeah.
1, the traditional Gold IRA, funded with pre-tax dollars. Good for high earners now who expect lower taxes later. You get the break today. 2, the Roth Gold IRA, funded with after-tax dollars.
Yeah.
Tax-free growth, tax-free withdrawals, and no RMDs. Great for long-term growth and estate planning. You get the break later.
Got it.
And 3, the SEP Gold IRA, the heavy hitter for the self-employed. Tax deductible with massive limits up to $72,000 for 2026.
Concise and clear. Now, before we let everyone go, we need to do the responsible thing. You have a specific disclaimer from the source, right?
I do, and this is important.
Yep.
We are analyzing the research, but your money is your money. The source states that all content is for educational purposes only and should not be considered personalized financial advice. Always consult with a qualified financial advisor before making investment decisions.
Absolutely. Talk to a pro who knows your specific situation. But here's a thought I want to leave you with today. We spend so much of our lives obsessing over the number in our bank account. We check the app, we want the number to go up. But how much time do we spend thinking about the quality of that money?
That's the real question.
We assume a dollar is a dollar. But if history shows us anything, it's that paper currencies can change, inflate, and lose value. Gold has been gold for thousands of years. So maybe the most important diversification isn't just which stocks you own, but whether you own something that isn't paper at all.
A provocative thought. It definitely makes you look at your portfolio differently.
Thanks for diving in with us today.
Always a pleasure.
See you next time.